Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jason Barsema, co-founder and president of Halo Investing, an investment platform for protective investments leveraged by financial advisors. Jason, it's great to have you with us. Welcome to Trade Talks.
Yeah, thanks, Jill. Nice to see you again.
You got it. And tell us more about Halo Investing and how financial advisors use the platform.
Yeah, so Halo is the global financial technology platform that gives financial advisors across 5 continents access to protective investing products. Predominantly structured notes, but also insurance products like annuities and buffered ETFs as well. And what's kind of interesting about Halo is it's not just about the connectivity, Jill, but it's also about the analytics and the content. So one of the things with our industry is that it was always kind of this esoteric, complicated asset class that most people didn't understand. So we took a big focus on education so people actually understood these products and where they go in the portfolio, analytics to see how they impact the portfolio, and then all the creature comforts that ultimately have gotten structured notes down from $3 million to $1,000, which is pretty novel in just 4 years.
Yeah, that is quite remarkable. So let's talk about the market for a bit. With current market conditions, we have low yields and high valuations. Financial advisors are seeing demand surge as more investors look for opportunities to bridge the gap between stocks and bonds. So how are investors shifting toward protective investments?
Yeah, you're precisely right. I think when you look at the market, you're really seeing 2 trends right now. Number one is there's kind of an exodus of private banking teams and wealth managers actually leaving the big wires and becoming independent. So it's actually forcing a lot of the other independent advisors to kind of keep up with the traditional private bankers and have more alternative investments in their portfolio, which is bode very well for Halo. But to your point, Jill, is the risk gap between stocks and bonds is the widest we've ever seen, and it's just going to continue to stay that way. And as 10,000 people retire in this country every single day, what do you do? Like, what do you do? And what do I do? Right? Are you going to put cash, to work in long equities where valuations are more rich than 1999 on a backward-looking basis, or bonds at a 160 basis point 10-year treasury? So structured notes are kind of a perfect bridge between the risk gap. To answer your question, where are they taking the money from? When people buy structured products, they're usually buying it with an equity exposure with a level of protection, Jill. So they're saying, hey, I still want to get some upside to the S&P 500. I just want that comfort of a cushion on the downside. So what they would do is they would sell their SPY exposure or US large cap core mutual fund and actually rotate into these structured notes. Case in point, just to kind of see the traction of this, with at least speaking from Halo's standpoint, in 4 years, we went from $0 in sales and transactions to last year we did over $3 billion in sales, and this year we'll do about $8 billion. And so I firmly believe we're in the very early stages, because the last point I'd like to make is this isn't just a short-term problem. The risk gap is a short-term problem in the markets, right? The long-term problem is the number of people retiring in this country and the number of people that are insufficiently saved. And that's where structured notes can provide income, protection, and a nice steady defined outcome return to help mitigate some of those challenges.
Right, considering that we really don't have pension funds anymore and Social Security might not exactly be the safety net that it once was. So Jason, let me ask you this. The 60-40 portfolio, I keep seeing everywhere that it just doesn't work anymore. Why do you think that is when you think about saving for retirement?
Yeah, it's funny, actually. I was just at a pretty big conference in Nashville, and my presentation was the death of the 60-40 portfolio. And part of that is when you look at some of the major challenges that we've seen in the markets, whether it was the COVID crisis, whether it was the financial crisis, the European debt crisis, name your crisis over the last 20 years, when the market pulls back, correlations go to 1, right? And so it's been really challenging for investors, because even when you saw in March of 2020, interest rates were actually going up because everyone was afraid that municipalities and even the government wouldn't be able to pay their debts. And obviously stock markets were down 30 to 40% across the board. And so that 60-40 no longer gives you, Jill, the diversification that you need in the portfolio. And as you said right now, think about, again, where equity markets are and bond yields are. You are facing a real reality for one of the first times in our life where interest rates could go up, which you'll lose money on your bonds. And obviously equity markets go down, you lose money on your stocks. How are you supposed to retire like that? And I think that that's where the power of what Halo does, which is not only disrupting structured notes, which were a ridiculously clunky asset class, but more importantly, democratizing structured notes. So all investors, not just a privileged few, have access to these protective investing products, has really been, like I said, a boon for our company, and for that matter, a boon for society, as we're here to solve the savings crisis.
Right, and to wrap up here, so if you're looking to generate income in this low yield environment that we're in, what are some strategies that investors are using?
About 80% of our flow over the last 3 months, Jill, has been an income producing structured note. So it's people buying a 3-year product linked to a few major indices, getting about 9 to 10% per annum yield. I love these kind of defined outcome style investments because probably you and me would agree that we just want to make 5 to 7% on our money. So that 10% yield or fixed return is something that's very interesting. And it comes with a level of 30% downside investment protection. So, I don't know about you, but I'm not sure where I could find that expected return and that payoff in today's markets.
All right, Jason, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.